We have the economy slowing down over the course of the year and entering a very mild recession next year, which frankly, from the Fed's perspective, is a good outcome. I mean, let's remember that they've raised rates 500 basis points over the course of 9 meetings. This is something that we wouldn't have imagined was possible sitting in 2021, right? Or we would have imagined that it would have had a significant impact on the economy. So a little bit of credit tightening, a slightly weaker economy, even a mild recession, I think is something that the Fed would absolutely accept if that's able to bring inflation back down to target. That's the key question, though. Yes, they can slow the economy down. Yes, we're seeing signs that they have been able to slow the economy down, but will that be enough to bring inflation back down to target?
And tell me what you think is happening beneath the hood of the headline numbers of the jobless claims, because what is happening in the labour market is very key to the Fed's thinking on rates. And I'm wondering how much companies maybe struggling a little bit in the current economic environment, but at the same time they don't want to let workers go because they've been through that really painful period where it was almost impossible to get good workers. And restaurants, etc., could only open maybe like 3 or 4 nights a week instead of a full 7 because they just literally couldn't find enough labour out there. Maybe there's a lot of labour hoarding going on.
Yeah, jobless claims are still very low by historical standards. We've moved off the absolute lows in this cycle to some slightly higher numbers. We were at 260 for a couple months. There were some distortions in the data from Minnesota. We're back down to 240. But whether it's 240 or 260, that is very, very low. I mean, I like to tell clients that I've been in the industry for 9 years, and we're still talking about the level of jobless claims. We're not thinking about the percentage of jobless claims as relative to the size of the total economy, right, which has grown significantly. So 240 doesn't mean the same as it did a decade ago or 2 decades ago. It's a much lower number. We think until claims move up to 300, possibly 350, you're not really in an environment where you can think about recession. And it goes back to the points that you were making, that the labor market is very tight. Possibly some labor hoarding going on, and generally just a very constructive environment for both the consumer and the labor market right now. Still probably some catch-up hiring as well in high-touch service sectors, also driven by demand in those sectors, so chicken and egg between the consumer and the labor market, and that's leading to a constructive dynamic.